Roughly 8 out of 10 high revenue business owners structure their companies as S Corps or partnerships, but most are missing out on the permanent tax savings the big beautiful bill just unlocked. We're talking 20% off your income every year, plus the potential for $10 million or more in capital gains to be taxed at 0% when you sell or exit. All right, let's chop. Hi, I'm Dr. Preston Cherry, founder and CEO of Concurrent Wealth Management, where we help you align your life and money to live your wealth your way. And if you love what you're experiencing on the show, please go ahead and hit that like and subscribe button. And don't forget to drop a comment. We always enjoy hearing your thoughts. All right. Stick around because in segment 2, we'll run a side-by-side of a real founder who walked away with $2 million with zero capital gains tax, and one who didn't plan and paid over $400,000 to the IRS. All right, let's start with a little bit of clarity because QBI and QSBS gets thrown around a lot, but most folks aren't clear on how to actually use them. So QBI stands for Qualified Business Income. If you own a pass-through entity like an S-Corp or partnership, QBI allows you to deduct 20% of your qualified income before calculating your taxes. So the so-called big beautiful bill just made that deduction permanent and no more 2026 sunset. And it raised the phase-out thresholds, giving you more room to plan and save. Now, for the QSBS, or the Qualified Small Business Stock, is your future tax strategy. If you convert your company to a C-Corp and issue QSBS stock properly, hold it for 5 years or more, you could exclude up to 100% of your capital gains on exit, up to $10 million or even more. And here's the connection. QBI gives you near-term tax efficiency while you grow. And the QSBS sets you up for your exit to be tax efficient too later on. So let's walk through a real world example because this is where it really gets good. Say you're a consulting business structured as an S Corp and you pay yourself $100,000 salary and take $200,000 in distributions. Well, under the QBI rules, that $200,000 gets a 20% deduction, which can amount to $40,000 in a tax deduction. And if you're in the 24% tax bracket, that saves you nearly $10,000 year after year. Now let's take it a step further. You're growing fast, right? Looking outside investors or a potential acquisition. This is popular. You elect to become a C Corp and issue QSBS stock early on. After 5 years, you exit at $5 million. Kudos to you. Because the stock meets QSBS criteria held for 5 years and it was issued when the company had less than $75 million in assets, you could qualify for a 100% capital gains exclusion on the first $10 million. That's $0 in federal capital gains tax. Let's put this in context. Someone without QSBS protection could owe 23.8% on that same gain. That's $1.19 million straight to the IRS. You don't want to pay them. And that's not hypothetical. That is a missed opportunity. All right, a quick break. If this strategy hits home for you, check out our Life Money Balance newsletter. It's free. Or book a Good Fit strategy call. It's free too. And the links are in the description. All right, so let's pivot to some common mistakes. And don't worry, this isn't about fear. It's about awareness. So here are 4 mistakes we often see at Concurrent Wealth. Number 1, owners just assume QBI just applies, but forget that it phases out at higher incomes. 2, some elect C-Corp status too late, disqualifying themselves from QSBS because the stock wasn't issued properly. 3, others sell their QSBS stock just short of the 5-year mark and miss the exclusion entirely. And lastly, they wait too long to implement and end up with a suboptimal structure after an LOI is signed. You see, by using the tax code and proper planning, you can align your legal structure, your timing, and your exit planning to keep more of what you're building. And here is the mindset shift. QBI is your ongoing strategy, and QSBS is one shot at tax free exit, your only shot. You don't need to chase every break in the tax code, but you do need to design your wealth with a runway intentionally. All right, that's all I got for you today. If this episode gave you clarity, share it with a fellow business owner and subscribe. Hit that subscribe button. And if it sparked some questions, then reach out. We're here. Schedule a good fit. It's free. The link is in the show notes. And before I go, let me leave you with this. You are working too hard to leave strategy and money on the table. And when you pair smart structure with forward planning, you just don't grow your business. You keep more of what you build and what you make, helping you grow to the freedom that you deserve. All right. Until next time, we'll chop soon.